Welcome to InvestorHubX.com. In technical analysis, some chart patterns appear again and again throughout the financial markets. Among them, the head and shoulders pattern is one of the most well-known and widely used by traders. This powerful formation has been observed for decades across many markets, including stocks, commodities, forex, and cryptocurrencies. When it appears after an uptrend, it often signals that buying momentum is weakening and that the market may soon reverse into a downtrend. There is also an opposite version of this pattern called the inverse head and shoulders, which often signals that a downtrend may be ending and that a bullish trend could begin. In this video, we will cover the head and shoulders pattern, the inverse head and shoulders pattern, imperfect head and shoulders patterns, failed head and shoulders patterns, how to measure the price target, and trading strategies using the head and shoulders pattern. Let's begin. This is the head and shoulders pattern. On the left, we have the left shoulder. At the top, we have the head, which forms the highest point of the pattern. On the right, we have the right shoulder, which is usually lower than the head. Connecting the two swing lows forms what we call the neckline. A break below the neckline completes the pattern and signals a potential trend reversal to the downside. Now let's take a look at how this pattern appears on a real chart. This is Bitcoin on the daily time frame. Can you see the head and shoulders pattern forming on the chart? The reversal point on the left forms the left shoulder. The higher peak in the middle forms the head, and the reversal point on the right forms the right shoulder. The support level connecting these lows is called the neckline. When the price breaks below the neckline, the pattern is considered complete, and the market often moves sharply lower. But why is the head and shoulders pattern considered a bearish pattern? If you recall from earlier lessons, when the right shoulder forms lower than the head, it means the market is starting to make a lower high. When the neckline breaks, the market then creates a lower low. A lower high followed by a lower low signals that the market structure has changed. In other words, the trend is no longer an uptrend. This is why the head and shoulders pattern is considered a trend reversal pattern, indicating that the market may be transitioning from an uptrend into a downtrend. While the head and shoulders pattern signals a potential bearish reversal, the inverse head and shoulders pattern tells the opposite story. It often marks the end of a downtrend and the beginning of a new uptrend. This is the inverse head and shoulders pattern. On the left, we have the left shoulder. At the bottom, we have the head, which forms the lowest point of the pattern. On the right, we have the right shoulder, which is usually higher than the head. Connecting the two swing highs forms what we call the neckline. A break above the neckline completes the pattern and signals a potential trend reversal to the upside. Now, let's take a look at how this pattern appears on a real chart. This is Bitcoin on the 4-hour time frame. Can you see the inverse head and shoulders pattern forming on the chart? The reversal point on the left forms the left shoulder. The lowest point in the middle forms the head, and the reversal point on the right forms the right shoulder. The resistance level connecting these highs is called the neckline. When the price breaks above the neckline, the pattern is considered complete, and the market often moves sharply higher. When the right shoulder forms higher than the head, it means the market is starting to make a higher low. When the neckline breaks, the market then creates a higher high. A higher low followed by a higher high signals that the market structure has changed. In other words, the trend is no longer a downtrend. This is why the inverse head and shoulders pattern is considered a trend reversal pattern, indicating that the market may be transitioning from a downtrend into an uptrend. As you have probably seen from the real chart, patterns are usually not picture perfect. If you wait for a perfect-looking pattern, you will miss most of the trading opportunities in the market. So, you need to train your eyes to recognize imperfect patterns. Here are some examples of imperfect head and shoulders patterns with skewed necklines. On the left, you can see a head and shoulders pattern where the right shoulder is lower than the left shoulder. In fact, this is even more bearish because the right shoulder forms a lower high compared to the left shoulder. On the right, you can see another head and shoulders pattern where the right shoulder is slightly higher than the left shoulder. However, the right shoulder is still lower than the head, which means the market is forming a lower high. When the neckline is broken, it confirms a lower high followed by a lower low, signaling that the trend may be changing from an uptrend to a downtrend. Remember, the market is messy. Successful traders don't look for perfect patterns, they look for probabilities. Next, let's talk about the failed head and shoulders pattern. Not every chart pattern works as expected. Sometimes the market invalidates the pattern, and this is known as a failed pattern. In a normal head and shoulders pattern, the price breaks below the neckline, confirming a potential trend reversal to the downside. However, in a failed head and shoulders pattern, the price either fails to break the neckline or quickly reverses back above it after the breakout. When this happens, it often traps traders who entered short positions. As those traders rush to close their losing positions, their buying pressure can push the market even higher. This is why a failed bearish pattern can sometimes lead to a strong bullish move. In trading, failures can be just as important as successful patterns, because when the market does not behave the way most traders expect, it often moves strongly in the opposite direction. Now let's take a look at how a failed head and shoulders pattern appears on a real chart. This is Bitcoin on the daily time frame. Here you can see a failed head and shoulders pattern. Normally, in a head and shoulders pattern, the price breaks below the neckline, confirming a potential bearish trend reversal. However, in this case, the market failed to continue moving lower after the neckline break. Instead, the price quickly reversed and moved back above the neckline, invalidating the bearish pattern. When this happens, many traders who entered short positions become trapped. As these traders rush to close their short positions, their buying pressure pushes the market even higher. As you can see, after the pattern failed, the market moved sharply higher. Now, let's talk about how to measure the price target of a head and shoulders pattern. This is the Bitcoin chart on the daily time frame, and here we can see a head and shoulders pattern. To measure the price target, first click the line tool and draw a horizontal line on the chart. You can hold the Shift key, then click and drag with the mouse to create a nice straight line. Place this line along the neckline of the pattern. Next, click the line tool again and draw a vertical line from the top of the head down to the neckline. This vertical distance represents the height of the pattern. After that, duplicate this line by holding the Command key and dragging, or simply right-click and select Clone. Then move the duplicated line to the neckline breakout point, like this. The bottom of this line gives you the estimated price target of the head and shoulders pattern. Now that we have a good understanding of the head and shoulders pattern, let's talk about some powerful trading techniques that traders use when trading this pattern. The first strategy is to short when the price breaks below the neckline. This breakdown signals that buyers are losing control, and a downtrend may begin. Traders often wait for a candle to close below the neckline before entering a short position. A common stop loss is placed above the right shoulder, and the price target can be estimated using the measured move method. The second strategy is to wait for the neckline to break, and then retest. After the price breaks below the neckline, the market will sometimes bounce back to test the neckline from below. This level, which was previously support, now acts as resistance. If the price fails to break above the neckline, traders may enter a short position, expecting the downtrend to continue. The third strategy is to look for the head and shoulders pattern forming at a key support or resistance level. When this pattern appears near a strong resistance level, it adds extra confirmation that the market may reverse downward. Traders watch for the pattern to complete and may enter a short position once the neckline breaks, expecting the price to move lower. The fourth strategy is to trade the head and shoulders pattern within an existing downtrend. In a downtrend, a head and shoulders pattern can form during a pullback to resistance. When the pullback fails and the pattern completes, it signals that the downtrend may continue. Traders often enter a short position when the neckline breaks, expecting the price to resume moving lower. The fifth strategy is an aggressive entry on the right shoulder. Instead of waiting for the neckline to break, traders may enter a short position when the right shoulder forms, especially if the price shows signs of rejection near resistance. This approach offers a better risk-to-reward ratio, but it also carries higher risk since the pattern has not yet been confirmed. To summarize, in this video we learned about the head and shoulders pattern, the inverse head and shoulders pattern, the imperfect head and shoulders pattern, and the failed head and shoulders pattern. We also discussed how to measure the price target of the pattern. Finally, we explored 5 trading strategies for applying the head and shoulders pattern. Understanding these strategies can help traders identify potential reversals and improve their trading decisions. If you found this lesson helpful, please give the video a thumbs up, subscribe to the channel, and turn on notifications for future lessons. I'll see you in the next video.